We remain absolutely focused on all the controllables in mining. There is, however, a positive trend, and there are indications that commodity prices are improving. And we're well positioned. We also know illusions. We can't control exchange rate. We can't exchange prices, but we can look after where we are in the cost, make sure we deliver the right volumes at the right time. A key message which I'd leave, and in particular around our iron ore and manganese, it's all around quality. And if a person looks at what's out there in terms of prices, and you look at the margins and the benefits and the premiums we get because of quality and the low impurities, and the whole world is driven around this issue of pollution out there, in particular China. And so the demand for quality metals is amplifying, and I think it'll bode on and our partnership well into the future. We see now that manganese is coming through. Our investment into manganese will bear fruit and benefits going forward. Most of our operations, as we stand and the way they're capitalized, are at steady state, but do have significant upside potential. Iron ore, as usual, has continued to deliver exceptional results. Costs are well controlled. We are benefiting from good quality grade and lumpy premiums, and that really bodes well for us. We had a record production delivery from the iron ore again this year.
Mike, can you give us a bit of a word picture on the way commodity prices are starting to lift?
We've seen through the cycle there are certainly signs of optimism, particularly coming out of China, and the demand and the stainless steel production is well up. And I think that in itself bodes pretty well for our suite of commodities. We look at iron ore demand is high, but the big issue around iron and manganese is all around the quality. And we see that the premiums coming through there are significant. It is a volatile environment, but with demand coming back and with what we see with pollution and environmental aspects in China and smelters closing down, all the current and new smelters, what they're looking for is that quality, so that they can obviously not create the problems in the environment, and obviously their costs of production are then significantly lower. But premiums which were $1 per unit 6 months ago are talking on $15 today. It is, whether that's sustainable or realistic or pragmatic, but even if it halves, Martin, it's a significant premium we see. And this message about quality has been coming through consistently for the last 3 to 4 years, and we see it now accelerating. So quality is the name of the game.
And are you in a sweet spot when it comes to quality of metal?
Absolutely. Last year, 55% of our product of iron ore was a lumpy, hard lumpy that can blend into the furnaces. When we look at manganese, our phos in all of our operations of manganese, whether it's the Gloria type ore, which is the sub 40 or the 40-45%, extremely low in phos and on huge demand. So they use it, albeit that we're a small iron ore player. It's a niche market where they use it for blend. And the manganese is so important to them in terms of that quality.
Electric vehicles are on the lips of many people at the moment. Which metals that you provide could go into the electric vehicle?
Predominantly manganese, huge quality of manganese going into the battery. Nickel, we'll realize well. Copper is going to be an important component. The current normal size car today uses about 8 kilograms of copper. An electric vehicle of tomorrow is going to use 38 kilograms of copper. Hence our focus on finding copper assets and getting into copper assets, because we think those are futuristic metals which will be in high demand, high premium, and again, as long as you get them at the right price, at the right end of the cost curve, and that you can feed into that market.
And there are two types of electric vehicles. There's the battery electric vehicle, which we're talking about now.
Yeah.
There's also the fuel cell electric vehicle, which uses platinum group metals, and you are also in that with your platinum.
One of the limitations up until now, and why it's fallen behind in the market from my perspective, is the hydrogen. But they're making significant progress. The recharge rates, and they're even putting on the market early discussions what they call a hydrogen gel, which is significantly smaller, less prohibitive, and certainly run for days on that. So that market is coming fast and furious, and so we remain focused on our PGM assets. PGMs remains a key focus for ARM.
And your Sakura project for manganese alloys, this seems to have gone particularly well.
Yeah. It's a world-class operation. It came in on time, on target, on budget. We held back with the ramp-up because the prices were slightly low, and we were considering whether you get into silica or one furnace on silica and one on high carbon. Prices have rapidly, significantly increased, nearly doubled in the last quarter, and again it's on that quality. And so we've stayed into both of our furnaces onto high carbon. So the ramp up is now exceeding nameplate capacity. The quality coming through there is good. The customers are very happy, and we're getting exceptionally good prices. And that business, which would have in our books taken some time to become cash flow positive, is already cash flow positive, and the payback would be significant. It also has uniquely an opportunity to more than double the capacity at the right time when the market wants it, and we can do refined metal there at the right time. It's a hot metal transfer, and at the right time, I think that'll bode us well. So huge opportunities, huge upside for us in the alloy business.
And coal has presented a bit of a challenge, particularly on the cost front.
I'm comfortable that the position they got into with GGV will, over the next 6 months, sort itself out. The main challenge that pit hit, it did go into a low-grade environment. It did compoundedly have shovel breakdowns and had a rain season, but it should have moved into another pit, and that license was delayed in the region of 2 years, and it only catches you 3 or 4 years. But we're in the other pit. Flexibility is there. We have ramped up to what would be a nameplate or a steady plate capacity on that, and the sales and the costs will come through. GGV and PCB are world-class ore bodies, well positioned on the cost curve, and will do well into the future.
ARM as a whole, what would be your #1 priority?
Driving productivity, driving efficiency, capital efficiency and costs. It's bode us well, it's served us well, and we're well positioned, and we've maintained volumes. If I would take a small outwarding look, if these persist, and we always want to balance cash to shareholders, and we want to continue grow, our existing operations in terms of the manganese, currently at 3, can go to 5 million over time. Our iron ore, currently 16 million, can go to 18 million sustainably. We own these ore bodies, we know them, we know the people. Our platinum assets, we could, in theory, we could double our platinum assets from our existing operations. If we look at our nickel, I touched on nickel's, our pit's got a short life of 8 years left. But if the nickel price changes based on the EV demand, and that's the electric vehicle demand and the sulfide nickel, there's an underground resource there of 14 kilometers, which could more than double the existing life. So I think from an internal point of view, ARM has huge upside opportunity to grow and exponentially grow its own business at the right time, and do it in a modular approach.
That was Creamer Media's Mining Weekly Online, speaking to Mike Schmidt, the CEO of African Rainbow Minerals.